For those of you who I have not met, my name's Kirsty and I'm the Content Director here at Brightday. With me today in the studio we've got Mitch, who is the Listed Investment Company Analyst with Eureka Report. Thanks for joining me today, Mitch.
My pleasure, Kirsty.
Now, to give you an overview, what we're going to do is talk about all the different types of managed investments that are available to invest in. Now, we're going to refer to Mitch as our expert on how you would pick a managed investment and what suits you. So we'll give you an overview of each managed investment, what you need to be looking for when picking one for your portfolio, and how you monitor these on an ongoing basis. But before we get stuck into actually walking through the finer details, we need to advise that this webcast may include general advice. It does not take into account your personal objectives, financial situation, or needs. Before acting on this information or acquiring a financial product, you should consider the relevant product disclosure statement. So, now we've got formalities out of the way, we want to get stuck into why you would invest with a portfolio manager. So Mitch, what are the reasons why you might consider having a portfolio manager look after some or all of your super?
Yeah, there are many reasons, and I think there's quite a few people out there in the last few weeks that are starting to reconsider things themselves. Competent managers of their own portfolio. Now the market is down today about 2%. So one of the reasons is not having the actual skill set yourself. For example, you wouldn't do any DIY dentistry on yourself at home. So if you don't have those expertise, you go to a dentist and they do that for you. So when looking to get involved in the market and you know the benefits of it, but you don't know how to do it yourself, then perhaps you should look to the experts, and of course you're going to have to pay them something for it. Additionally, you might have the knowledge base, but you might be working full time, or you might say have retired and you've got grandkids to look after, you've got holidays to go on. Because managing a portfolio and investing in stocks and researching stocks, it does take time. There's people out there who do it as their full-time job, these portfolio managers. So if you don't have that time, it's best to look to those experts. So they're just two of them. There's also just the ease of handing it over as well. Taking care of all the paperwork. Say if you've got a portfolio of 20, 30, 40 stocks that you're running, your letterbox is generally pretty full with paperwork. So, it cuts down and simplifies a lot of things.
That it does. I really like the fact that you related it to DIY dentistry, because I think sometimes we can think that we know what we're doing, but it is a lot more complex when you're investing in, say, international shares. While you might use Facebook and Google, doesn't mean you should be evaluating whether or not they're good companies to buy.
Yeah, that's exactly right. And another reason which you've just reminded me of by saying that is, so you might be a very competent investor yourself. You might have been running a portfolio, a self-managed super fund for a long time and outperforming the market and outperforming some managers even as well. However, you've heard recently that international investing, it has become quite the flavour of the month, so to speak, and you think you need more diversification in that respect to your portfolio, or you want to be active in emerging markets, and you want to be active in Asia and whatnot. You don't have that expertise. You know the companies in Australia, you know what they do, you've followed them for years. However, selecting those types of companies in Asia or in America or whatnot, you just don't have that. So you know enough to know what you don't know. So you then go and select a manager who does.
It's a handy way to go about things. So there's lots of different managed investments that are out there. We've got managed funds, listed investment companies, exchange-traded funds, and separately managed accounts. Now, they're all very different. So we're going to tap into Mitch's knowledge first and get him to tell us what a listed investment company is.
Right. So a listed investment company is similar to a managed fund, but the first name, the first word in its name, could tell you why it's a little bit different. It is listed on the market, so you can go out there today and buy a listed investment company. Now, behind a listed investment company, when you're buying it, you're buying a managed portfolio, managed to a certain theme or mandate that the manager sets down. And behind that, of course, you're getting an investment team. that
Yes.
are running that portfolio on a day-to-day basis for you. Now, unlike a managed fund, there's no minimum investment levels into a listed investment company, and just like anything on the market, it can be trading above what fair value is, or it can be trading below what fair value is, which is measured by the listed investment company's NTA. Now, the companies have to announce what they're actually worth, so it's quite handy. Every month, you see some doing them weekly now, and there's one even doing them daily. So you know where you stand. But also with a listed investment company, they're a closed-ended structure, basically meaning they raise capital when they say list or do an IPO, and then they have that capital and they can manage that capital as shareholders come and go. You can buy and sell shares. It doesn't impact at all the actual underlying portfolio that the manager is investing.
Now, that's actually a really unique feature of listed investment companies that sets them apart of managed funds
That's
and
right.
ETFs. So can you please explain why that fixed pool of capital is so important, especially in market conditions like we're experiencing at the moment?
Exactly. So right now, in market conditions, right now you've got, say, managed fund portfolio managers sitting out there, and they've got what's called an open-ended structure, basically meaning if you're sitting at home and thinking, geez, I do not want a bar of this market right now, I want to sell up and just go away, you send in your redemption request. That manager has to sell stock to fund that,
Right.
Unless they've got the cash at hand to fund that request. Now, when the market's on the nose and you're seeing headlines in papers such as the one that I literally just read, 30 billion wiped off markets today, you might not be the only one sitting at home thinking of that. So a manager might have 20, 30, 40 redemption requests coming in, who knows what size for, and they're a forced seller right at the exact time when they don't want to be selling. So they're selling into a falling market, they're crystallising losses, and everyone else in that portfolio is impacted by that. Now, on the other end of that scale, when the market's running hot, everyone's talking about the market, everyone wants to jump into the market, a fund manager could be receiving funds, all this capital comes flooding in right at the exact time they don't want it, when they can't deploy it into cheap stocks. So that's the manager's hands are tied slightly by that. Now, when you look at LICs and listed, because of the closed-ended structure, they know what they have. People could sell the stock down, and the share price could go down well below the value of the actual portfolio. So that's like market sentiment really driving it down. But that portfolio remains solid, and so it kind of gives the manager there the freedom to really think long term and see through these current cycles and see through the volatility that we're experiencing right now.
That's great. Thanks, Mitch. Now, just for everybody at home, I'll just recap the key points of a listed investment company. So as Mitch was saying, they are closed-end structures. So if a listed investment company goes out today to start a portfolio and raises $100, it'll invest all of that money, and that money will stay invested. Now, for investors to have a slice of that portfolio of $100, they would buy shares that are traded on the ASX. Now, those shares may trade at more or less than what the underlying unit is worth, and that was the net tangible assets that Mitch was talking about. Now, managed funds, I feel like you've given us a pretty good overview. So the key point that I guess people at home would want to know is that because they are open-ended structures, it can mean that they are selling when they don't want to be and buying when everyone else is buying, and I guess prices are going up. Is there anything else that we should know in terms of how do you buy them and what's the price that you pay for them?
With a managed fund, and this can be a benefit or not when comparing them to LICs, you actually buy them at the value of that portfolio on the day. So you're buying every single stock in that portfolio at the price that it's at that day. So there's none of this discount to net tangible assets or premium, so you don't have to worry about that. Then also, would say that another benefit of managed funds over LICs are there are a lot more of them.
Yes.
There are a whole stack of them that do all sorts of different things, that give you access to all sorts of different markets, investment styles, asset classes, whereas LICs, they're a fairly niche section of the market. There's only a real handful of big players there. There are more coming onto the scene, but you're seeing IPOs there of maybe 100 million, 200 million max, not overly liquid.
Right.
So that's another benefit that the managed funds do have over LICs. But saying that as well, there is a bit of more lead time when applying for a managed fund. You have to send in your application form, you have to send in a redemption form, and now a managed fund could calculate its net asset value, the value of the underlying portfolio on a daily basis. So that means you'll be able to get your funds back quicker, but they might do it on a weekly basis. Which means you might have to wait to the end of the week, or even on a very rare case, a monthly. Whereas with a LIC, it's on a daily basis, and you've got that settlement time of T+3.
Great, thanks. Now with the liquidity, what Mitch was meaning by that is that if you want to buy or sell a listed investment company, let's say you're buying it, you need somebody who's selling it to buy their units from them. And generally people who own listed investment companies, at least here in Australia, they don't tend to buy and sell frequently. So it can be hard to come about buying shares in a listed investment company at a price that you're willing to pay. Now the last main managed investment that I want to go through before we skip to the next slide is exchange traded funds.
Yes.
Go for it.
Okay. Exchange traded funds. Well, basically, it's giving you the ability to buy an index or a theme, say emerging markets.
Or maybe say the ASX 200.
ASX 200, the MSCI World, or the US dollar. And they are passive investments. By that, what I mean is when you buy them, when you buy the market, you are buying exactly the components of the market in the weightings that they make up.
So if Commonwealth Bank makes up 10% of the Australian market, the ETF of the ASX 200 is going to have 10% to CBA. Is that correct?
Exactly right.
Right.
And so you will get the exact movement of the market.
Okay.
So ETFs are great for playing out themes. If you if you called the Australian dollar pulling back from 90 odd cents down to where it currently is, you would have been very happy if you purchased a US dollar ETF. You could have done that. Now, one thing that does also separate them from the managed style of investments are typically their fees, because there are fees associated with an ETF. They're quite a bit lower than your standard managed fund or LIC. Saying that though, if you look at the biggest LIC out there at the moment, AFI, it actually has a lower management fee than the majority of ETFs. That's just because of its size. But also another big difference is the liquidity issues with an ETF don't exist, because you've got a market maker on the other end.
Right. So what Mitch is saying with an ETF is that you can always buy and sell at a price that reflects what it's actually worth. Exactly.
How ETFs make their money, of course, they charge that very small management fee, and there's a buy-sell spread on the entry and exit.
Yes. Now, lots of people at home are obviously going to be interested in the amount of income that these investments can offer them. Now, aside from the fact that you can invest in an Australian share fund, which is going to pay a higher income than, say, a US share fund, can you explain the difference between the income that you receive from a managed fund, listed investment company, and ETF, and where franking credits fit into that?
Yeah, certainly. A managed fund is typically a trust structure, whereas a listed investment company, the last word there gives it away, it's a company structure. So between the two, a trust has to pay out all income that it receives throughout in that financial year. So they can't store any income up for a rainy day. So if they have a good year, you could be getting a landslide of income coming towards you. Whereas a listed investment company, basically, they because they're a company structure, they have a thing called profit reserves, which means they can squirrel away some funds for a rainy day. They can, if they take profit from a position, they can bank some of that in the reserves and look to really even out the income over the years. Or perhaps if it's really building up, and they can build up the franking credits because when they take profit, they're paying tax as well. They can even say pay out a special dividend if they've really got some building up there.
And I guess the main difference between listed investment companies and managed funds for investors is that listed investment companies offer, well, most of them do anyway, franking credits, whereas managed funds do not.
Yeah, correct.
And the same goes with exchange traded funds. You only get the proportion of the dividends. You only get franking credits in relation to the proportion of dividends paid that have got franking credits attached to them. So that means that an Australian index ETF might only pay about 75%.
Yeah, it very well may do. I mean, when you're buying the index, you are, essentially buying the good, the bad, and the ugly companies out there. You're buying some companies that pay dividends and don't pay fully franked ones. I know Macquarie Bank, for example, didn't pay fully franked dividends for a very long time. So you're
getting a mixed bag.
Exactly, the offset, you are getting companies that do pay fully franked dividends. So that's correct.
Now, I feel like we've got a really good overview of the managed investments. So how do we actually go about picking a good manager? What should you be looking for?
Sure. When I'm looking for a manager, and this is say in a managed fund or a listed investment company, because under the bonnet they've got the same crucial elements. I'm looking for people and process.
Right.
That's my two core things. One, the people, are they experienced? Have they been there before? Have they done this before? Have they got a track record that you can go and look at now? They may have just started at a fund, but they've been somewhere else. You can just whip out Google, put their name into it, and you can see their tenure at another fund. Look at the performance. If you go to a fund's website and they don't have the performance up there, that might tell you something as well. Or if it's not easily accessible, that might give something away. But back people who have been there and done it before. Sorry, go on.
So you're looking for people that have built portfolios and managed portfolios before, and they've done well.
Yeah, people who have got, especially say right now, people who've been through corrections before.
Yes.
As well, they've had the experience of the GFC. They might have had the 2002 with the .com bubble, but they might have experienced even the 87 correction. So people who have been there, done that, and can bring that experience to the table. Those cool level heads. Then going on to process, because it's ultimately those people who put that process out there and into play. Go with a process that sits well with you, that resonates well with you. If someone's trading the portfolio quite heavily, be it in a LIC or in a managed fund environment, that might not sit well with you. You just might not like that investment style. So go with something that does sit well. If you are long-term focused and like sound fundamentals, then of course pick someone who does that. And then the proof's in the pudding. See what they've been able to do over the last, say, 10 years. I generally wouldn't look at, I like to see minimum 5-year performance. Now, of course, past performance is no indication of future performance. However, I do want to back someone who's done it before.
Yes.
Yeah.
Now, when we talk about performance, are you comparing them against a benchmark or your own internal measure that every fund manager should return 10% every year? What's the...
I think it's fair to just to compare them to their benchmark.
Okay.
Because what you want to see is someone who does what they say they're going to do, someone who's true to label. Now, if they say, our goal is to beat the All Ords Accumulation Index year in, year out, do they do it? Or they could be a total return fund manager, which means they set, we want to get 10% per annum. And that's what they set it out. Now, if they might miss it on 1 year or 2 years, But if they then overshoot it on the third year and the fourth year or whatnot, and it averages out over a 5-year period of that 10% plus, then they've done their job. So just compare them to their benchmark, and then when you are comparing funds, make sure you're comparing apples with apples, and the benchmarks help do that.
That they do. Excellent. So in the interest of time, there's lots more that we could talk about on how to pick a good manager, but we've got a few questions coming through, and I just want to go on to the next slide, which talks about brightday's featured funds. This is a tool available on the website. You can find it under the research tab. Now, it has managed funds, listed investment companies, and exchange traded funds, and you can search for product type, and then you can search for asset class, whether that be shares or fixed income. And it summarises the performance over 1, 3, 5, 7 and 10 years if the funds go out to sort of that 7 to 10 year mark. And you can see how well these funds have done. Now, this is the top performing funds in the asset class based on what's available through Brightday's platform, whether it be Complete Super or Total SMSF. If you're a Brightday member, I'd encourage you to jump onto this and have a look, because I think you'd be pleasantly surprised that some of the funds on here have done exceptionally well, and they've met Mitch's requirements on performance, and they've been consistent. Now, ongoing wise, how do I know that the listed investment company or the managed fund that I've got is doing what it should be doing?
Sure, they will report back to you. A managed fund will, of course, send out quarterly statements to you.
Yes.
And you'll be able to see how that tracks, and you'll be able to see how that goes against the index. Of course, they'll also have, they'll typically tend to have investor presentations as well, so you can go along and you can, and I encourage people to go along and ask questions.
Oh, good. I was hoping you would say that. It's always good to put the managers under the pump when you can.
Yeah, I've been in a few hairy investor presentations, as a spectator, and they're quite interesting. But no, yeah, definitely, it's your money. Go and question them. Absolutely encourage that. With an LIC, they report to you either on a monthly, in some cases weekly, in one instance a daily performance report. That NTA is the performance. So have a look at it, see how much it's grown, keep a little spreadsheet yourself. And just track it and see how it's going compared to the benchmark. They make it pretty easy to see the performance, and you can see the share price on a daily basis. So that's what you perhaps should be very wary of as a LIC investor as well is total shareholder return. So that's the share price and the dividends. You can look at the net tangible assets, but also the TSR is what you're getting.
Yes.
So it's important to you. Now, an ETF, you're going to get what you're going to get. So watch the market, watch the index that you're tracking. There are some newer, fancier ones out there at the moment that are doing blurring the line between LICs.
But we won't worry about
those. No, we won't worry about those.
Now might be a good time to segue onto the questions before we actually run out of time.
Yes,
but the key is for monitoring ongoing performance is basically it's your job to keep up to date with what the funds are doing on a quarterly basis, and all the funds now have got great material that you can download monthly and quarterly. It's one pages, so a little bit of time will keep you up to date with everything that you need to know about your fund. Now, I've got a question here from Philip. He says, do you favour investment in international over Australian equity funds at the present time? That's a little bit of a difficult one to answer, so we won't go into great detail, but the Australian share market has definitely underperformed international markets so far year to date, but it doesn't mean that that should be the basis for making investment decisions today.
That's correct. And the Australian market makes up 2% of the global market as well. So there are a lot of other opportunities out there in the world that aren't available on the Australian market. So
exactly right.
There's a lot of dynamic companies, but saying that the Australian market has pulled back significantly, and some people, market commentators out there, are seeing value appearing right now. So.
6 of one, half a dozen of the other. That was a sit on the fence return. Sit on the fence answer.
Yeah.
Seth wants to know, what is a good return from a fund? You're aiming to beat the ASX, but by how much?
That's a That's a tricky question because say if you're aiming to beat the ASX by how much? Well, I guess you have to look at your risk-adjusted returns. How much risk do you want to take to beat that? I mean, you can go into say an LIC or a managed fund that basically very closely tracks the index, but it'll beat it by 1 or 2%. It depends on what you need as well. Don't go out there and trying to shoot the lights out and taking lots of risk when all you might need for your lifestyle is 6%. So yeah, it's a difficult question to answer, that one, but yeah, it depends on your risk appetite as well. Like you might be wanting to go up that risk curve, get an LIC or a managed fund that invests in small caps and mid caps and does a few little tricky things to add performance, but you might be content with getting market returns.
So when Mitch is talking about risk-adjusted returns, he's saying that if you opt for the small cap fund with the manager that's taking bets on up-and-coming companies, whilst there's a chance to say maybe get 20% return in 1 year, there's the equal chance that you're going to lose 20% in a year. And in terms of context, that could be significantly more than what the wider market would lose. Now, got a great question here from Maeve. Thanks for asking. I'm trying to work out whether LICs, managed funds or ETFs make sense for me. How do I think about these? Mitch, I'm going to answer this one.
Good.
So it really comes down to what you want the investment for. If you would just like to own Australian shares because you've decided you want to put 20% of your portfolio in Australian shares and you're happy with a return the same as the market, then an ETF is perhaps the best option for you. If you want to do a little bit better than the market, or if you want a manager that's going to protect some of your money if share markets are going down like they are at the moment and they've got the option to hold a little bit more cash, which a lot of managed funds do, then you might want to look at a listed investment company or a managed fund. But it really, all you need to think about, Maeve, is what do you want your exposure to the asset class to do? If you're happy with market returns, ETFs are quite often the way to go. But if you want to do a little bit better than what the market could do, you'd be better off looking at some listed investment companies or managed funds. Now, I've got a question here from a guest. Is there one place where I can access performance reports of all of the funds? I use various sources, but somewhere with a search facility would be great. I think our featured funds tool would help you with that greatly. It's the only aggregating tool that I'm aware of at the moment that's available for free. Now we're running out of time, so we've only got time for a few more questions. Let me find one. This is a good one from Luke. There's a mountain of evidence over the past half century that clearly points to the fact that overall active managers have failed to outperform a passive index approach. So that's the listed investment companies and managed funds versus ETFs. Obviously, chance alone will mean some active managers do beat the market, but what the relatively poor record of active managers, why would someone pay someone to earn them less than a simple passive approach? Do you have any thoughts on this?
That's a very, very valid point. There are a lot of managers out there in the listed investment company space and in the managed fund space that haven't provided value. They've been charging fees and they don't provide value. And so you want to avoid those because you can just go to an ETF and pay very little fees and get those exact same results or better results than a lot of the active managers. So you have to be really selective. And I know with brightday you guys have actually sifted through and found managers there with your featured funds that have added value. Essentially, that's what you're looking to find. And saying that, do look at fees on an LIC and on a managed fund, and just actually see what you're getting for it. So no, he's absolutely right. There's been a lot, but at the same time, there's been a lot of managers out there that have provided consistent, steady performance that year in, year out beats their benchmark at a reasonable price, and I'm happy to pay up for that.
You're exactly right. And a lot of managed funds as well, and it, I believe, distorts those reports that you could possibly be referring to. They are mandated to invest in line with the benchmark or the index, so it doesn't leave them a lot of room to go and find a bunch of companies that are potentially going to grow at a quicker rate and have rising share prices versus the rest of the market. So while there's lots of data out there, you've got to look at what makes up that data and why. On our last question, it touches on fees. It says, do you have a view on whether performance fees are a good or a bad thing? Do managers who get paid that way typically have higher performance? I can give you the official brightday view on this. Fees, we have to pay somebody to manage our money, and you should always look at the return after fees. So that's after the cost has been accounted for to run the fund, the managers have been paid. In terms of performance fees, it's one of the only ways to align managers getting good performance with, I've lost my train of thought, but performance fees can be a good thing, especially when the managers who are managing that money have also got their own wealth invested in the fund. So good managers should be rewarded for returning better returns than the market. And how do you do that? It's quite difficult. So performance fees is one of the only ways.
That's exactly right. It helps keep the manager's interests in line with shareholders, with investors.
That's what I was trying to say, but I got tangled up. Thank you.
That's all right. You prompted me. And also, though, when looking at it, because the bulk of funds out there right now have performance fee incentives in place, but look for the words high watermark.
Yes, that's a good one.
Really important that you basically means if they get 10% one year, charge you a performance fee on that, then they fall back 10% the next year, and then the following year they go up 10% again. You don't want them clipping the ticket on that extra 10% just to get you back to square one.
That's right.
A high watermark basically means they need to get back to the highest point the fund got and then perform above that for them to clip the ticket on a performance fee. So really look for those words, high watermark. It's really key.
Great. Thank you so much, Mitch. On that, we will leave it there for today. So, Mitch, thank you so much for joining me here in the studio and sharing your knowledge with the brightday audience. If you would like to know more about brightday's featured funds or brightday in general, please indicate at the bottom of the webcast screen that you would like a phone call from one of our member services team, and we look forward to speaking to you. Otherwise, we'll leave it on that for today. Thank you.